This is your week ending report for the 20th of June. My name is Meir Walensky with Driving Markets. Let's kick off. Right, so the main focus this last week was interest rates. Interest rates, Bank of Japan, interest rates in the US, interest rates in the UK. We'll cover those and we'll go over all the economic numbers and of course speak about the geopolitical events, what's going on in the Middle East. So let's focus a little bit on the interest rate environment. So the Bank of Japan kept interest rates as they are, did not increase interest rates. Now that's interesting and I'll tell you why. There's been a lot of focus on Japan as rising interest rates and they have a bond problem. The main problem they have is that their GDP to debt is around about the 236% level. In other words, their debt ratio is so high that their GDP, their gross domestic product, the money that they produce, will never pay off the debt. And that's going to put pressure on the Japanese economy. Not only that, there's an overall view amongst analysts and traders that Japan will start increasing its interest rates and therefore the yields on those bonds would rise and therefore they become more attractive to investors and traders to buy those bonds. In addition to that, there is a move by Japan's main pension funds and main investment funds to repatriate, to repatriate the $1.5 trillion in US investments, bonds and other types of investments back into Japan. If there was or when there is a repatriation of the $1.5 trillion from the US back into Japan, then the yen is going to strengthen because they're going to end up converting the dollar into yen. So we did a yen trade already about 10 months ago when we sold dollar yen at about 162 and now it's running at about the 142, 144 level. I do expect dollar yen on the FX sector to move towards the 135 as the yen strengthens and the dollar gets weaker. Talking about dollar, let's move on to the FOMC, the Federal Open Market Committee meeting that was held on Tuesday and Wednesday. Woe and behold, Jerome Powell, head of the Fed, came out with no further interest rate cuts. Now, there's no further interest rate cuts in the US. So in the Japan, we're expecting an interest rate rise, and in the US, we're expecting interest rate cuts. That alone on dollar yen would mean the dollar would go down and the yen would go up. But let's go back now and just focus on the US. What are they concerned with? It was quite a hawkish statement that came out from the Fed after the meeting on Wednesday evening, and they're stating quite clearly that inflation is sticky. It's still there. It's hard. They're not looking to reduce interest rates in the near term. So the dollar rose on the back of stronger interest rates and markets came off a little bit due to the fact that a strong dollar and no cheap money coming in the near term pushed equity markets down. However, I do expect in July the interest rates to be the same, but in September, traders and investors and analysts are expecting some sort of cut in the US. Now, Jerome Powell has stated, or the Fed stated, that there will be 2 interest rate cuts this year. When will they be? Probably September, maybe October time. That's when the likelihood is that rates will be cut in the US. But meanwhile, you're going to have a stronger dollar on the back of that hawkish statement from Jerome Powell at the Fed. Moving on to the UK, which is in dire straits with a GDP of about plus 0.1%. It's really going into negative territory very, very soon. The UK economy is in disaster zone. And yet Andrew Bailey, who's got no balls, Andrew Bailey came out and said that they're not going to be reducing interest rates. Well, interest rates need to fall in the UK to get the UK economy going. And yet, for some reason, the Bank of England does not see the urgency in reducing interest rates. In the UK, we've got rising unemployment and smaller, lower overall business volumes of business activity. That is a danger sign when it comes to economic activity. And Andrew Bailey of the Bank of England MPC Monetary Policy Committee, they don't seem to see the urgency in reducing interest rates, and interest rates need to come down quickly as far as the UK is concerned. Talking about other events, well, everyone is fully aware of what's going on in the Middle East, and that's impacting oil and gold. And just over the weekend, the US struck the 3 nuclear facilities in Iran using B-2 and B-52 bombers, whichever bombers they used, and 30,000-pound bombs to explode in the Fordow underground, deep in the mountain nuclear facility. That has spiked gold and oil on the futures on the closed market over the weekend. So we expect oil to be extremely volatile over the coming days. We expect gold to continue moving up towards the 3,500 level. My main target on gold is around about near term 36, 36.50. All depends how it pans out. If Iran does get into bed with China and Russia and North Korea and they deliver a nuclear bomb to Iran, then that could kick off oil and gold even further. On top of that, Iran has threatened to close the oil routes in the Straits of Hormuz and in the Red Sea, and potentially they could attack the Saudi Arabian gas fields and oil fields, and that would spike oil all the way up to around about the $120 level. Talked about cryptos, obviously Bitcoin, risk of attitude as there's tension globally, then you see Bitcoin and the crypto sector come off. It's waiting for some direction there. So as far as Bitcoin and the other cryptos are concerned, a little bit under pressure due to global tensions. Bond yields, again, would have come down. Bond prices go up because it's a go-to safe haven when you're talking about a global crisis. That's more or less it. Wraps it up with the driving markets weekend summary. Hope you have a good weekend and we'll keep you updated. Catch you later.